There are 6 things happening at the intersection of Social Security and Medicare that the people who run both programs will never sit you down and explain. And most of you are losing money on your monthly payment because of it, month after month, for the rest of your lives. Here is what I'm going to walk you through today. Number 1, the way your Medicare Part B premium is quietly deducted from your Social Security check before you ever see it, and the calculation error that is affecting more people than you would expect right now. Number 2, the income-related surcharge that can raise your Medicare premium without a single change to your actual income this year, simply because of how the timing works. Number 3, the hold harmless rule that is supposed to protect your Social Security check from shrinking because of a Medicare premium increase, and the specific group of people that rule does not fully protect. Number 4, the enrollment timing mistake that can permanently increase what you pay for Medicare for the rest of your life, and why most people do not find out until it is too late. Number 5, the coordination gap between the two agencies that causes payment delays, processing errors, and confusion for people who are turning 65, retiring, or experiencing a life change at the same time. And number 6, the one move available to certain Social Security and Medicare recipients right now that can lower what comes out of your check before your very next payment date. Stay with me to the end because that 6th one alone could put real money back into your pocket before your next deposit arrives. And let me be clear about something right now because most people assume none of this applies to them. It does. Whether you have been on Medicare for 1 year or 20 years, whether you are collecting Social Security on your own record, a spousal record, or a survivor benefit, whether your premium gets deducted automatically or you pay it separately, and whether you turned 65 recently or you turned 65 a long time ago and have not looked closely at this relationship since. Social Security and Medicare are run by 2 different parts of the federal government, the Social Security Administration and the Centers for Medicare and Medicaid Services. They share information, they coordinate payments, but they are not the same system, and the handoff between them is where most of the confusion, most of the errors, and most of the lost money happens. Now, these are real federal program rules sourced from SSA.gov and Medicare.gov. The exact dollar amounts and eligibility details depend on your individual income, enrollment history, and benefit type. This is not financial advice, so verify your own situation directly with the SSA or Medicare before you act on anything in this video. Number 1, the Part B premium deduction, and the calculation error affecting more people than you would expect. Here is the rule in one sentence. If you are enrolled in both Social Security and Medicare Part B, your monthly Part B premium is automatically deducted from your Social Security check before the remaining amount is deposited into your bank account, and the amount deducted is supposed to match the exact premium tier your income qualifies for, but the system does not always get that match right on the first try. Think about who this affects. Think about the 70-year-old man who has been collecting Social Security and Medicare for 5 years. His standard Part B premium in 2026 is approximately $174.70 per month. That amount comes out of his Social Security check automatically every month before he ever sees the deposit. He has never questioned the number because it has always looked roughly the same. Now here is the part that almost nobody understands, so listen closely. The amount deducted depends on which income bracket the SSA has on file for you, and that bracket is based on your tax return from 2 years prior. If your income dropped, if you had a one-time high income year that has since passed, or if there was simply an error in how your income was reported or transmitted between the IRS and the SSA, the premium tier applied to your deduction may not match the tier the law says you actually qualify for. The mistake most people make is assuming that because the deduction happens automatically, it must be correct. Automatic does not mean accurate. It means the system applied whatever value was in the file at the time the deduction was processed. If that value was wrong, the deduction has been wrong every single month since then, quietly reducing your Social Security deposit by more than the law requires. You can check this in about 2 minutes. Log into your My Social Security account at ssa.gov and look at your benefit verification letter or your most recent payment notice. It will show your gross Social Security benefit, the Part B premium deducted, and the net amount deposited. Compare the premium amount shown to the standard 2026 premium of $174.70. If you are being charged more than that, and you do not believe your income qualifies you for a higher bracket, that is worth investigating immediately. And that leads me straight into number 2, because the reason your premium might be higher than the standard amount often has nothing to do with what you are earning today. Number 2, the income-related surcharge, and why your premium can rise without your income changing at all. Here is the rule. Medicare uses a system called IRMAA, the income-related monthly adjustment amount, to charge higher Part B and Part D premiums to higher income beneficiaries. And the income used to calculate that surcharge is not your current income. It is your income from 2 years earlier. Think about who this affects. Think about the woman who sold a rental property in 2024 for a significant gain. Her income that year was unusually high, far above her normal retirement income. In 2026, because of that 2024 tax return, she is paying an IRMAA surcharge on her Medicare premium, even though her actual income in 2026 has returned to its normal, much lower level. She is paying more for Medicare right now based on a financial event that happened 2 years ago and will never happen again. Now here is the part that shocks people the most. The IRMAA brackets in 2026 start adding surcharges once your income from 2024 exceeded approximately $106,000 for an individual or $212,000 for a married couple filing jointly. At the lowest surcharge tier, you pay an additional $69.90 per month on top of the standard Part B premium. At the highest tier, the surcharge adds over $419 per month, per person. That is not a small adjustment. For a married couple both on Medicare, the high-tier surcharge can add over $10,000 per year in additional premium costs. The mistake most people make is assuming this charge is fixed and permanent once it is applied. It is not. There is a specific appeal process using Form SSA 44, the Medicare Income-Related Monthly Adjustment Amount Life-Changing Event Form, that allows you to request a recalculation if your income has dropped due to retirement, the loss of a spouse, reduced work hours, or certain other qualifying events. If your high-income year is behind you and your 2026 income is meaningfully lower, you may be able to have your premium reset to reflect your current situation rather than your 2024 tax return. They do not exactly advertise this form. It is available at ssa.gov, and the SSA processes these appeals more often than most people realize. They just have to be asked. And that leads me into number 3. A rule that is supposed to protect your check from ever shrinking because of Medicare, but that has a specific gap most people do not know about. Number 3, the hold harmless rule, and the group of people it does not fully protect. Here is the rule. Federal law includes a provision called the hold harmless rule, which generally prevents your net Social Security payment from decreasing from one year to the next, solely because your Medicare Part B premium went up. If the cost of living adjustment to your Social Security benefit is smaller than the increase in your Part B premium, the hold harmless rule caps the premium increase so that your net check does not go down. Think about who this protects. Think about the retiree whose Social Security benefit increases by $20 a month due to the annual cost of living adjustment, but whose Part B premium is scheduled to increase by $25 a month. Without the hold harmless rule, her net check would actually decrease by $5, even though her gross benefit went up. With the hold harmless rule in place, her Part B premium increase is limited to the $20 cost of living increase, so her net check stays exactly the same instead of dropping. Now here is the catch nobody tells you. The hold harmless rule does not apply to everyone. It specifically does not protect people who are subject to the IRMAA income-related surcharge I just described. It does not protect people who are newly enrolling in Medicare Part B for the first time in a given year. And it does not protect people whose Part B premium is being paid by Medicaid, rather than deducted directly from their own Social Security check. The mistake most people make is assuming that because they have heard of the hold harmless rule, they are automatically covered by it every year, regardless of their situation. If you fall into a higher income bracket or if you are new to Medicare, this protection may not apply to you the way you expect. Checking your own benefit verification letter each year, comparing your gross benefit, your Part B deduction, and your net payment year over year is the only way to know for certain whether the rule applied in your specific case. And that brings me to number 4, an enrollment timing mistake that can lock in a higher premium for the rest of your life. and most people never find out until it is far too late to fix. Number 4. The enrollment timing mistake and the penalty that follows you permanently. Here is the rule. If you do not enroll in Medicare Part B when you first become eligible, and you do not qualify for a specific exception, such as still being covered by an employer group health plan through active current work, you may face a late enrollment penalty that increases your Part B premium by 10% for every full 12-month period you were eligible but not enrolled. And that penalty does not expire. It applies for as long as you have Medicare Part B, for the rest of your life. Think about who this affects. Think about the man who turned 65 while still working part-time at a small business that did not offer group health coverage. He assumed, incorrectly, that because he was still working, he did not need to enroll in Medicare yet. He delayed enrollment for 3 years before realizing his employer's plan did not qualify him for the work-based exception. When he finally enrolled, the SSA applied a 30% permanent late enrollment penalty to his Part B premium. 3 full 12-month periods of delay at 10% each. Now here is the part that almost nobody understands. That 30% penalty is not a one-time fee. It is a permanent increase to his premium percentage, recalculated against whatever the standard premium happens to be in any given year, for as long as he is enrolled in Part B. In 2026, with a standard premium of $174.70, a 30% penalty adds approximately $52.40 per month, over $600 per year, forever. Not for a few years, for the rest of his life, every single month, on top of whatever the standard premium happens to be at the time. The mistake most people make is misunderstanding the work-based exception. The exception only applies if you are covered by a group health plan based on your own current employment, or your spouse's current employment at a company with 20 or more employees in most cases. Retiree health coverage, COBRA coverage, and coverage through a small employer often do not qualify for the exception, even though they may feel similar to active employer coverage. If you delayed Medicare enrollment for any reason, and you are not certain whether you qualified for the work-based exception, contact the SSA immediately and ask them to review your enrollment history. In some narrow circumstances involving misinformation from an employer or insurer, penalty relief through what is called equitable relief has been granted, but it requires documentation and a specific request. It is not offered automatically. And that leads me into number 5, the coordination gap between these two agencies that causes real problems for people experiencing a major life change. Number 5, the coordination gap, and why turning 65 or retiring can create a processing mess. Here is the rule. The Social Security Administration and the Centers for Medicare and Medicaid Services operate on separate systems, separate timelines, and separate processing schedules. When you experience a life change that affects both programs at the same time, turning 65, retiring, losing a spouse, or starting Social Security while also enrolling in Medicare, the coordination between the two systems does not always happen smoothly or quickly. Think about who this affects. Think about the woman who retired at 65 and applied for both Social Security and Medicare in the same month. Her Medicare Part B enrollment was processed within a few weeks. Her Social Security benefit took longer to finalize because of a separate review of her earnings record. During the gap between those two processing timelines, her Part B premium was billed to her directly because there was no Social Security check yet from which to deduct it automatically. She received a bill she was not expecting, was not prepared to pay quarterly out of pocket, and had to scramble to set up a direct payment method before a deadline that she only found out about from the bill itself. Now here is the part that catches people off guard. Once your Social Security benefit does begin, the Part B premium deduction usually transitions automatically from direct billing to automatic deduction from your check. But that transition is not always immediate, and it is not always communicated clearly. Some people end up double paying for a month during the transition, both a direct payment and a deduction, and have to request a refund for the overlap. The mistake most people make is assuming that because they applied for both programs together, the systems are talking to each other in real time behind the scenes. They are connected, but the connection has processing delays. If you are approaching a Medicare enrollment milestone at the same time as a Social Security filing, ask both agencies directly how your premium will be billed during the transition period and follow up in writing if anything about your billing changes unexpectedly. And now, that brings me to number 6, the one I told you about at the very beginning of this video, the move that could lower what comes out of your check before your very next payment date. Number 6, the Medicare Savings Program and the deduction reduction most eligible seniors never claim. If you only remember one thing from this entire video, remember this. There is a federal program that can pay your Medicare Part B premium for you entirely, which means the deduction that currently comes out of your Social Security check every single month could stop, and your net deposit could increase by approximately $174.70 per month, starting as soon as your application is approved. This program is called the Qualified Medicare Beneficiary Program, or QMB, and it is the most comprehensive of the 4 related Medicare savings programs administered through state Medicaid offices. If you qualify, the program pays your Part B premium directly, and in many states it also covers your Part A premium, if applicable, your deductibles, and your co-payments. Here is the income threshold, and I want you to listen carefully because it is higher than most people assume. In 2026, a single person can qualify for the full QMB benefit with a monthly income up to approximately $1,075. A married couple can qualify with a combined monthly income up to approximately $1,452. Many states have also eliminated the asset test for these programs, meaning your savings account balance, your car, and your home equity generally do not disqualify you. Now here is the part that stops people cold when they hear it. If your Social Security benefit alone is close to or below those thresholds, you may already qualify and you may not know it. And if you qualify and you successfully enroll, here is exactly what changes. The Part B premium deduction that has been coming out of your Social Security check, $174.70 per month at the standard rate, or more if you are subject to a surcharge or penalty, stops. Medicaid begins paying that premium directly to Medicare on your behalf. Your gross Social Security benefit does not change, but your net deposit, the actual amount that lands in your bank account, increases by the full amount of the premium that is no longer being deducted. Think about who this helps most. Think about the 73-year-old widow whose only income is a Social Security survivor benefit of $1,040 per month. Her net deposit, after the standard Part B premium is deducted, is approximately $865. If she qualifies for QMB, and at her income level she very likely does, that deduction stops entirely. Her net deposit rises to the full $1,040. That is an increase of nearly $175 every single month, starting with her very next payment after approval. Over a year, that is more than $2,000 staying in her pocket instead of leaving it automatically before she ever sees it. Here is why almost nobody applies for this. The application goes through your state Medicaid office, not through Social Security or Medicare directly. Many seniors hear the word Medicaid and immediately assume it does not apply to them. They think of Medicaid as a program exclusively for people in poverty, or they confuse it with long-term care Medicaid, which has much stricter asset rules. The Medicare Savings Programs are a completely different application within the Medicaid system, with different income rules, often no asset test, and a much broader population of people who qualify than most realize. The mistake most people make is never applying because they assume their income is too high, based on outdated thresholds or based on confusing QMB with other Medicaid programs entirely. The only way to know for certain is to apply. The application is free. It can be submitted through your state Medicaid office, and you can find your state's specific application process by visiting Medicare.gov and searching for the phrase Medicare Savings Programs. For the rest of your life, every single month, that Part B premium is either coming out of your check or it is not. And the only thing standing between those two outcomes for many seniors who qualify is a single application that has never been submitted. So here is the one thing I want you to do today. One thing, free. Takes about 15 minutes. Go to ssa.gov and log into your My Social Security account. Pull up your most recent benefit verification letter or payment notice. Find 3 numbers on that page: your gross monthly Social Security benefit, your Part B premium deduction, and your net monthly deposit. Write those 3 numbers down. Then compare your Part B premium deduction to the standard 2026 rate of $174.70. If it is higher, find out why, whether it is an IRMAA surcharge, a late enrollment penalty, or a calculation error. Then take your gross monthly benefit number and compare it to the QMB income threshold for your household size, approximately $1,075 for a single person or $1,452 for a couple in 2026. If your income is at or below that range, contact your state Medicaid office this week and ask specifically about the Medicare Savings Program. The day you do that, the day you actually look at those numbers side by side and ask the right office the right question, every single thing in this video stops being information about other people, and it starts being your own deposit, your own premium, and your own next payment date. So let me tie the whole thing together, because this is the entire game in 3 sentences. You are very likely paying more out of your Social Security check toward Medicare than the law actually requires, through a premium tier that may be outdated, a surcharge that may no longer reflect your real income, or a penalty that could potentially be reduced. But the SSA and Medicare deduct what their systems calculate based on the information they have on file, not what is most accurate for your current situation. And nobody, not the SSA, not Medicare, not your state Medicaid office, is going to call you and offer to lower your premium or correct an outdated calculation. You have to check the numbers yourself, and you have to ask the right office the right question before your next payment date arrives. Before I let you go, 3 things. Please do all 3. They genuinely matter. First, tell me in the comments which of these 6 things you did not know about until right now. And tell me this too. Have you ever checked your Part B premium deduction against the standard rate or applied for a Medicare Savings Program? I want to know how many people watching have already done this versus how many are hearing about it for the first time. Your answer helps me know what to cover next. Second, if this is the first time anyone has explained how Social Security and Medicare actually interact, the deductions, the surcharges, the penalties, and the savings programs, in plain English without the runaround, subscribe to this channel. This is what I do here. Every rule that affects what actually lands in your bank account, I bring it here and explain it clearly. The next video could be about the exact thing standing between you and a higher net deposit. Subscribe so it finds you before your next payment date. And third, send this to one person you care about who receives both Social Security and Medicare. A parent, a sibling, a neighbor, a friend from your community. You do not need to explain all 6 points to them. Just send it and say, watch this before your next payment date. Because the odds are very good that someone you know is paying more out of their check than the law requires, and they will not find out unless someone who watched this video today decides to share it. You now know what to check and where to look. Share this so someone else gets the same chance. Take care of yourself, and I will see you in the next one.